Welcome to Buydowns and Credits. My name is Carlden Lainfiesta. I'm the broker owner of Monarch Mortgage. Today we have a very good presentation for you guys that's going through what all this stuff even means, right? How do you buy down the interest rate? How do you get to the lowest rate today? Is it worth it? I want to keep this class interactive as well. So as those of you come across questions, feel free to let me know. Oh, and I have a little bit of theme music, so. All right. So who am I? My name is Carlden Lainfiesta. I've been in this industry for over 13 years. I'm an experienced mortgage loan originator. I've closed over 500 loans over the course of these 13 years, purchase, refi, HELOC transactions. I'm a graduate of California State University, Northridge, go Matadors, with a business degree in marketing. Born and raised here in Los Angeles, California, father of three, a member of Alpha Phi Alpha, of course, the Inglewood Board, LA Southwest, Consolidated Board as well. My passion is entrepreneurship and assisting homeowners in realizing their dreams. So my contact information will be appearing a few times during this presentation, including here on where you guys see my face. That's my contact information. You can pull out your phone, scan the QR code if you need it, and that'll give you access to me. So what is Monarch Mortgage? Monarch Mortgage is an independent mortgage brokerage located in Los Angeles, California, and approved to offer residential mortgages in 6 states. Monarch receives wholesale rates through over 40 approved banks, and that helps their clients save over $9,000 on average instead of using a direct lender. We have fast turn times, great service and technology, and we close, which is most important, right? So here's a graphic of the states we're licensed in and growing. For those of you who have any clients that are relocating to Las Vegas, Nevada, Texas, Florida, Pennsylvania, Michigan, we are licensed in all of these states. So even though we're located here, or even if they're in the Bay Area or San Diego or Victorville or something, we're licensed in the entire state of California. So people sometimes think, oh, you're in Los Angeles. Well, in today's day and age where we're doing loans digitally, that does not matter, okay? So just keep that in mind if you have any clients in different areas or looking to relocate. I don't do this by myself. I have a whole team here of loan officers as well as assistants that help us get loans done. So this is a majority of the team here, as you can see. We have people in different areas as well. Ryan is over in the Riverside area. Craig Bryan is over in Orange County. So we have a lot of different people on our team to assist you guys, okay? And before we hop into buy downs and credits, I hope you guys understand the difference between wholesale and retail. So let's talk about it a little bit, okay? So wholesale is basically Monarch Mortgage. We are a mortgage brokerage. That means that we work with other wholesale lenders, okay? These are your UWMs, which is United Wholesale Mortgage, your Rocket Mortgages, your New Res, your EPM Financials, a lot of wholesale lenders out here, okay? So we are not the actual bank that are loaning the money. We work with the bank that loans the money, okay? Has its benefits by us being able to do that. So for example, we can offer loans through multiple banks using one credit pool, okay? Those of you who have ever had a client that's been declined by a bank, that's a very painful process if you're in the middle of escrow. That means essentially you have to cancel escrow with that bank and start over all over again with a new lender at a new bank, okay? That does not happen with mortgage brokerages because we're able to switch banks without having to start the process all over again, okay? So it's a very big deal if you ever run into any issues, okay? And we're still using the same credit report. Pricing better than retail and with more flexibility with guidelines and exceptions. We'll get into why that is during this class, actually, because we'll be talking about rates and buy downs and all that kind of stuff to give you guys an idea, okay? Retail, one bank. I worked retail most of my career. Been in business now with Monarch Mortgage for 4 years. We just hit our anniversary, or it's about to come up actually, November 1st. one bank model is kind of dead. You know, if you send your loan to one bank, if they decline you, you have to start all over again. The new bank needs a new copy of the credit report. You're working directly with a loan officer, but they're only able to offer the products that they offer, right? So if you run into a situation, it's like, hey, you know what, this is not working out. Going with you know, an investment loan, we need to go with DSCR, or we need to switch this up to a bank statement loan, or we need to go with a 1099 only loan. We have the ability to make a lot of those changes here while keeping the same credit report and moving you forward with a different bank. Before we hop into the knee deep into the presentation, this is also an introduction to a seminar that we have going on. This is something that you guys can invite your clients to, okay? So it's called A Home for Holidays, a home buyer seminar. The reason why this is kind of important, and I actually wanted to advertise it here, is because with the buy downs and credits, and you have down payment assistance, your clients can really achieve a net $0 out of pocket to purchase a house. Okay, so that is still possible in today's day and age. You need down payment assistance to do it, and then we have loans that cover the closing costs to make you whole. And I'm gonna be muting people as you guys pop up off mute. So if you guys have any questions, and I do want to keep it interactive, feel free to ask, but I also want to make sure we don't have any noise going on in the background, okay? So to register for this, you guys can scan the QR code on this. This is only being presented by my team here at Monarch Mortgage. There's no other realtors presenting at this. This is really information purposes for clients that allow them to get information on down payment assistance, and also some of the mortgage basics and how we assist with credit, okay? So that's going on this Saturday. If you know anybody who wants to attend, when they register on Eventbrite, they'll have to put who they referred by, make sure they put you, and that'll take care of everything we need to make sure we get them pre-approved and back to you, okay? So before we could talk about buy downs, we have to talk about interest rates. I hope you guys know what interest rates are, but here we go. What is the interest rate? And excuse me if I'm not talking directly to the camera because I got 3 screens over here. An interest rate is the cost of borrowing money or the return on saving money expressed as a percentage of the principal amount. For a borrower, it's the price paid for using someone else's money, while for a lender or saver, it's the compensation earned. Factors like inflation, supply and demand for money, and government monetary policy all influence interest rates. So what happens when interest rates decrease? Anybody know? This is where we could get a little interactive here, guys. What happens when interest rates decrease?
Sorry, decrease or increase?
Decrease.
Oh,
Hey,
more
can you see my
buyers?
screen, by the way?
No.
You said no?
Oh, sorry. Yes, yes.
Okay, cool. Yeah, what happens when interest rates decrease?
More buyers?
When interest rates decrease? No, typically you get more buyers.
Yeah, that's what I said.
Oh, okay. I'm sorry. I thought you said no buyers. So see,
And I said more buyers.
okay, yeah, more buyers. Okay, and what the effect of that is house prices increase, right? As you get more competition into this market, you start to see sellers want more for their house, okay, or buyers start to increase the price by so many people submitting different offers, driving up the price. So the purpose of using what we're going to start off with is permanent buy downs, okay? So you can increase the affordability or permanently lower the interest rate, reducing the monthly payments. If you're a seller, or even for builders, because we have, we'll talk about that as well. But for sellers, you can use buy downs as an incentive. So if you're a listing agent and your client is considering reducing the sales price of their home, another option could be to offer a buy down, right? As part of the purchase. Hey, we're willing to pay for you to have a buy down. And we'll talk about why that could become an important strategy a little bit later. offset high rates and a rising interest rate environments. Buydowns help buyers manage costs, assist with closing costs. Credits can help cover expenses like the appraisal and title fees. So the purpose of using permanent buydowns: lower your initial payment. It's a long-term savings. It's a negotiation tool without reducing the property sales price. Flexibility: buyers can choose between temporary relief and permanent savings based on their financial goals. And there's some tax advantages. Points paid for permanent buydowns may be tax deductible, but I'm not a tax advisor, so you have to consult with one, okay? Let's talk about interest rates real quick, because this has to make some sense before we go into this. This is what, well, there's a few different projections on here, okay? But the market rate forecast is to remain above 6 for 2025, but should gradually decline over the next year or two. With different forecasts predicting different rates, Fannie Mae forecast at the end of 2025 will be at 6.3% and 5.9% by the end of 2026. Conversely, Mortgage Bankers Association is more conservative, predicting rates to end at 2026 at 6.4 and 6.3 at the end of 2027. Okay, so the forecast that I think we're in line with as we approach the end of 2025 is Fannie Mae's, who, you know, it all depends on who you are. I trust people who do loans to tell me about loans. Okay, so the rate they have is 6.3, and we are basically hovering around that rate today. Okay, and the forecast for 2026, Fannie Mae expects to drop to about 5.9% by the end of 2026. So as this happens, guys, we're going to start to see a lot of people enter the market to purchase again as rates go lower and lower, okay? So what difference does the interest rate make? Wanted to keep this realistic to the market that we're in. I'm in Inglewood, California. Next door is Los Angeles, California. And the average home price in this area is about $800,000. So I wanted to use that as an example, okay? So if you buy a house for $800,000, and the interest rate in the first column, if you look towards the bottom here, is 6.625%. As interest rates go down, whether that takes a year, 2, 3, however many years it takes, to let's say 5.125%, that creates a savings of $743 a month, just off the difference of an interest rate, okay? And a lot of these rates, you don't have to wait that long to get to that rate, and we'll talk about why. Give me 1 second here. All right, so we also have, for example, if you were to buy a $500,000 house, interest rate 6.625 goes down to 5.125, savings of $464 a month, okay? So maybe that's not a lot to you, but if you can, live a better life off of $464, it can make a huge difference, okay? And that's on a lower purchase price. So what is a buydown? AKA permanent buydown, AKA discount points. So what is it, right? So the general concept, and then we'll look at some examples. The general concept is that it reduces the interest rate for the entire life of the loan. This is on a permanent buydown. We haven't gotten into temporary yet, so that we're talking about permanent right now. This is achieved by purchasing discount points at closing. Each point usually costs 1% of the loan amount and reduces the rate by 0.25%. However, it is more expensive the lower the rate goes, and we'll take a look at that as well. Can be paid by the buyer, the seller, or builder as part of the negotiations. And before I forget, because I do forget this, you guys know that when you go to new builds and they ask you to work with the preferred lender, that builder credit is what they're calling it, that builder incentive, can be used by any lender, okay? There are some credits that the lender gives that I can also give, but that builder incentive can go to any lender that borrower chooses, okay? Typically, they still want you to be approved by the in-house lender, and of course, they want you to close with the in-house lender, but I've had scenarios, two most recently over the past year, where my pricing was better than the in-house lender, used the incentive they got from the builder, and still offered them a better loan without the lender credit than what they were getting from the in-house lender. So just something to keep in mind when it's talking about getting incentives from the in-house lender, okay? So here's an example. So I'm a mortgage broker, and this is kind of what my pricing looks like. So I'm going to walk you through what you're looking at, okay? So this is an $800,000 purchase price, putting 3% down. So that's why this loan amount is 776, because it has 3% down, which is why it's 97% LTV, a 740 credit score on a conventional loan, 30-year fixed, okay? So these are different banks here: Plaza Home Mortgage, American Financial, PRMG. These are the first ones that popped up here in my pricing engine, okay? It's kind of showing you here what the interest rate is per bank. The first one starts off here, 6.125%. Discount points, 0.44%. That means that it's going to cost $341 to this borrower if they want this interest rate, okay? Now, when you're talking about brokers, their compensation is also tied into the rate. So if I make 1.5% on this loan, this is going to be their pricing. I switched over a few banks to kind of, I'm pretty much at 1.5 almost, anywhere between 1.5 and 2%. But if you look here at 1.625, now the pricing is more expensive. 1.75, the pricing is a little bit more expensive, okay? So it's something you guys have to keep in mind, that this is a negotiation when you're working with a broker, that if we have to beat a lender, we can. We might have to lower our compensation to get this to roll over to points, but we can. Before I continue and leave this screen, any questions so far? Okay, I'm going to roll into this. So this first slide, no, let me not say slide, excuse me. This first bank here, I basically clicked on this bank and opened up their pricing. So this is kind of what their pricing looks like, okay? And this is like a behind the scenes view. Sorry, Lionel, did you have a question? Okay, I'll mute him. All right, so this is basically a behind the scenes view, guys, because as a real estate agent, realtist, or what have you, you don't see a lot of this stuff broadcast, right? This is typically what your lender is looking at, right? So in today's market, for this interest rate, this borrower would have to pay $341. That means that $341 is added to the borrower's closing costs, okay? If the borrower said, hey, I want a 5.49% rate, or hey, give me the lowest rate you could possibly give me, all right? It's going to be, now this is the lowest on this snapshot. I should point that out, okay, because it does go lower, okay? But this is just an example. To get you to a 5.49% interest rate, it's going to cost you $18,000. Okay, so some people say like, okay, well, why is this person offering them a 5.875% and you're offering a 6.125%? The question then becomes, are they paying any points, right? Because these are points that we're talking about here, discount points. They could be paying $7,600 to get this rate through another lender. And most banks don't even tell the client that. And they run into an issue when it comes down. They'll tell them the cash to close, but they don't point out that they're paying points to get to that interest rate, okay? So conversely, let's say that your borrower needs more money, right? As a lender, we can give them a credit if we raise the interest rate. So if you look at 6.625 down here, then they'll get back $7,372 towards their closing costs if we raise their rate to 6.625. Now, all of this, of course, pertains to the monthly payment. So for example, here, which is what I'm considering par. Par is basically the closest interest rate to zero, meaning zero cost, right? All interest rates pretty much have a cost. I do have banks where you can make that get all the way to zero, so they're paying no cost at all. But typically there's a slight cost for the rate. It's very hard to get it to land directly on zero unless you offer them a, I don't know, 6.126 interest rate might make you hit zero cost, okay? If you guys look at this, it's $4,715. This is principal and interest. I don't believe that it's, it's not taxes and insurance are not included in this. So this is just principal and interest. Keep that in mind for these examples, okay? But it's $4,715. So if you were to buy this rate down, payment becomes $4,401. That's $314. but you're paying $18,000 to get there. What do you guys think? Is that a good idea? Don't all jump in at once and start speaking. It's so rude.
I guess it depends. They're
Yeah.
gonna keep it for 30 years, yeah.
If they're going to keep it for 30 years, yeah. Okay, cool. Kelly, were you going to say something too?
Well, something similar. So yes, just
Okay.
to figure out how long it's going to take them to kind of pay it back or to pay themselves back for losing that 18,000. So
Do most people keep a house for 30 years without refinancing?
no.
No, they don't, right? So this is something that we have to kind of be cognizant of, guys, as we are creating homeowners or helping people refinance or helping people buy their second property. They're not going to keep this rate for very long, okay? So some people might go the opposite way around. Hey, instead of me paying $341, let me get back $7,000 towards my closing costs. Now, what does that do? That raises my payment about $250, right? So if I'm raising my payment $250, but I can refinance out of this loan. And the earliest you can refinance, by the way, I say is about 7 months. Some people say 6 months, but it's really 6 months of payments. So from when the client closes and they skip that first month, it turns out to be about 7 months, okay? So about 7 months later, your client can refinance to get out of that rate. So if they took $7,000 to get them into this home and have them pay no closing costs, and they pay an additional $250 for 12 months, that's $3,000. They essentially saved $4,000 in this scenario, okay? I'm a numbers guy. Some of you may not be. So if you need me to slow down, let me know. But I just wanted to give you an idea of kind of what this looks like when we talk about a buy down, okay? Keep in mind, this is a permanent buy down, not temporary. Any questions on this slide before I continue? Okay. So let's talk about temporary buy downs. So temporary buy downs are reducing the interest rate for the first few years. Common structures are 2-1 buy downs, reducing the interest rate by 2% in the first year, 1% in the second year, and then returns to the full rate. We also have a 1-0 buy down. That's reducing the interest rate by 1% in the first year, 0% in the second year, then the full rate applies. Typically funded by the seller or builder to make the home more affordable initially. Funds are placed in an escrow account to subsidize monthly payments during the buy down period. So let's look at what this looks like. This is a temporary rate buy down calculator. This is something that one of my partners, UWM, has available from, and it allows us to kind of look at basically what a buy down consists of, okay? So if today's interest rate is 6.5%, keep in mind this is still an $800,000 purchase price, but they're putting 3% down, so the loan amount is $776. 6.5% interest rate, 360 360 months. Kind of appears in years. And then we have the PMI factor, 0.55%. Estimated escrow annually. So this is taxes and insurance lumped into one. It's about $12,800. Number of payments per year, 12. Monthly payments, $5,625. So that's kind of what they would be paying initially, okay? Double down options, cool. All right, so let's look at the breakdown of this. I'm actually gonna go a little bit backwards because I want you guys to see the 2-1 buy down before the 1-1. So on this 2-1 buy down, they start off, they're locked in. Keep in mind, this is not an adjustable rate mortgage. So keep that out of your mind because this is dealing with a fixed rate, okay? So for the first year, their rate would be 4.5%. Their no payment was originally supposed to be $4,203. With this buy down, getting them down 2% lower than where they started, because they started at 6.5 and now they're at 4.5, the payment is $2,910. That's monthly savings of $1,293.33. Annually, that's $15,000 in savings. Next year, it goes to 5.5%. from where the note rate was, that becomes, and when I say note rate, this is basically principal and interest. The buy down payment is $35.56. Monthly savings $646. Total cost savings $7,759. So to do this 2-1 buy down, it's going to cost $23,279. The buyer can pay for it, the seller can pay for it. If the seller pays for it, it is rolled over if the buyer wants to refinance, right? So that, let's just say that they took this loan and they stayed in it for 1 year, right? That means that this whole $15,000 goes away, but they still have $7,759 left in that savings account. So if they go to refinance this house, they don't have to come out of pocket to pay for the refinance. So the buy down can help pay for the refinance, which is a great resource, but it has to be paid by the seller. Now, as we look at this 1-0 buy down, this is basically lowering the interest rate by 1% for the first year. It's basically the same number, but it's only for 1 year, $7,759. Okay, so now this is a temporary buy down. Now, the reason why some people would elect to take a temporary buy down is because we're in a declining interest rate environment, excuse me. I've been doing this for 13 years, right? There's only been like maybe 1 or 2 years where we knew interest rates were going to go down, okay? Or they're slated to go down. Now, obviously, it's not a straight line. Matter of fact, it's a rocky road. But you know, the fact of the matter is we are lower today than where we started at the beginning of the year, and we're projected to have a lower interest rate. The Fed to lower the interest rate at the next meeting, and for them to continue to lower interest rates throughout next year. So we're in an environment where if somebody buys a house today for today's price, that's slated to go up as interest rates go down, they're in a position to refinance to that lower payment in a year. Okay. Any questions here about the temporary buy down?
I have a question.
Debbie? Go
Just to go back to what you said, if the seller pays for the buy down, it can roll over. Why can't it roll over if the buyer pays for a buy down?
When the buyer pays for it, it's basically like a cost to themselves. When the seller pays for it, it's like considered like a seller credit. And the seller credit basically has to be used towards closing costs, right? So if the person pays it themselves, it's kind of this weird, thing, but it's true when you think about the concept of a loan, right? When a seller gives a credit, that credit can only be used towards closing costs. So if this person decides to leave this loan and go to a new loan, that seller's credit can be used towards closing costs still on the new refinance, okay? But if the buyer pays this themselves, well, it's just a cost to the buyer.
So it's not considered a closing cost. That's the part confusing. Usually it's just part of the loan side, not the closing side.
Well, if you look at this, like, let's just use the 1-0 buy down as an example. This amount, the $7,759, is considered closing costs.
For
So
both the buyer and the seller, if the
Yeah,
buyer does it.
correct. So it doesn't matter who pays for it, it's considered closing costs, right? But if the
Okay.
seller pays for it, then it can be rolled over towards a refinance, which is why we want to push for the seller to pay it, right? If you have to write a higher offer in order for them to give you $7,000, that might be worth it, because at least when a buyer does their refinance, they don't have to come out of pocket $7,000. And it shouldn't be coming out of pocket anyway. It's typically rolled into the loan. But the point being is they get to save that $7,000. But thank you for that question, Debbie. Any other questions so far? Because I need this to make sense. When you go to your listing agent, when you're the listing agent and you go to your seller and you're saying, hey, I think we should offer a temporary buy down as an incentive to help somebody purchase your house. If they can get a 6.25 or a 6.5, they'll start off 2% less, and it's still a fixed rate, and it gives them time to adjust to purchasing the house. It gives time for interest rates to go down at the same time, and it pays sort of for their refinance if they want to do that, right? So, that's what this is about. So we'll keep it pushing. If there's no more questions about temporary buy downs, I must say this is probably the hardest concept for most people to get is, like, where does the money come from? And essentially, if you really look at this, if the buyer does this, they're just prepaying their mortgage payment. That's all they're really doing. They're taking the savings they would get and they're paying it in a lump sum. If the seller does it, it creates a benefit, more of a benefit. If the buyer does it, they're just prepaying their mortgage. All right, let's move. So upfront buy downs versus lender credits. Upfront buy downs, what it is: paying money at closing to lower the interest rate. The effect: to lower interest rate. Cost impact: higher upfront costs, lower monthly payments. Lender credits, what is it? Accepting a higher rate to reduce closing costs. Effect: higher interest rate. Cost impact: lower upfront costs, higher monthly payments. So one of the thoughts that I want to make sure you guys understand in this declining interest rate environment is when a person doesn't have to pay that much money for their down payment, or even if they pay their down payment, but they don't have to pay their closing costs, and they're looking to, most people are going to refinance in a year, no matter how you cut it, because everybody wants to save money. So anywhere between a year to 2 years, they're going to be in this loan. Most of the time, they'll end up saving more money, taking a lender credit and refinancing in a year to lower that monthly payment than they would if they took the lower interest rate and refinanced in a year. Okay, so it is something that we have to be cognizant of when people are talking about, oh, I want the lowest rate, I want the lowest payment. Yeah, but you're only going to be in that payment until you refinance. Now, there, of course, is not always guaranteed that somebody's going to have a job or have the credit score or have the everything necessary to refinance. There are certain programs, like if the person purchased FHA, they can refinance without a job. They still kind of keep the credit score in mind, but they don't even have to have employment on an FHA streamline refinance. So the strategy is a very good strategy for those people who are looking to purchase but don't want to be locked into a high payment for a very long time. So let's shift to this other concept here, which is interested party contributions. You know what that means, guys? That means like a seller credit, right? That means if a seller decides to give your buyer credit, that's an interested party contribution. Interested party contributions are payment made by parties with a financial interest in a real estate transaction towards the borrower's closing costs. So that includes you as the real estate agent, that includes me as a lender, that includes the seller, right? And there's certain rules to interested party contributions, okay? We also have the builder and developer listed here. But any party that could benefit from the property selling at the highest price is considered an interested party. Interested party contributions cannot be used to make the borrower's down payment. So if you get a seller credit, it can only be used towards closing costs. If you get a lender credit, it can only be used towards closing costs because it cannot be used towards the down payment, okay? So interested party contributions, and what are the rules to it? So if you're getting a conventional loan, or your buyer is getting a conventional loan, this is the maximum amount of interested party contributions depending on the amount of money they're putting down and the residence type. So if it's a primary residence or second home and they're putting down less than 10%, then the maximum they can get is 3% towards their closing costs, which is why most of you use that as a rule. Oh, they can only get 3% back, because typically they're putting down less than 10%. But if they're putting down more than 10%, up to 25%, they can get 6% back from the seller or the interested party or the lender, right? If they're getting, if they're putting 25% down, they can get 9% back from interested parties, okay? And the interested party contribution, it does add up. So let's say you're getting a lender credit and you're getting a seller credit. If you're getting both of them together, and the person's putting down less than 10%, it cannot exceed 3%, for example, okay? So all the interested parties cannot exceed 3%. Investment property, 2%. So this is the conventional side, okay? When we go to FHA, VA, USDA, FHA, no matter how much you're putting down, the maximum they could get is 6%. VA, the maximum 4%. USDA 6%. Okay. So this is important because it takes your buyer's closing costs out of the mix if they're getting it from the seller or the lender. Okay. And let's talk about the lender. Definition of a lender credit is it an interest rate credit. Sorry, an interest rate credit is a lender concession where the borrower accepts a higher interest rate in exchange for credits towards closing costs. Instead of paying the upfront fees like discount points to lower the rate, the borrower agrees to a slightly higher rate. The lender then provides a credit that can be applied to closing costs. That includes the appraisal, title fees, escrow, prepaid expenses such as taxes and insurance. The trade-off, you save on upfront costs, but you pay more over time due to a higher interest rate. Credits cannot exceed the actual closing costs. Okay. So here's an example. We going back to Plaza home mortgage here, and we're looking at now where the person can get a 7.125% interest rate. It's going to raise their payment. Keep in mind, 6.125 was par, right? So their initial payment would have been about $4,715. Okay, so if we go to this strategy, it's going to raise their payment $500 per month, but it's going to give them $13,000 back towards their closing costs, right? This is pretty much enough. This is almost 2% to wipe out the majority of the closing costs, if not all, depending on the month they're closing. Okay, so this could take care of the entire transaction, but their payment would be $500 higher. What do you guys think? Would you do it?
The question without that answer. So let's say they pick that scenario and you're close to the top of their credit limit. What about then if the seller is going to credit the buyer for the agent's compensation at 2.5%? Those numbers don't work.
If the seller is going to credit the buyer for
the agent compensation, that's a credit, right?
So that I don't believe that crosses over. So like if the seller is paying the buyer's agent, which is typical for the transaction, that's not a part of the interested party contribution for the loan. So if they pay you, let's say 2.5% or 3%, that does not come out of what it can be used that's paid towards the buyer's loan. Does that make sense?
Okay. So it's a different line item, nothing to do with that.
Exactly, yeah.
Okay, thank you.
No problem. Good question, though. So is it worth it for this person to take a $500 higher payment to get $13,000? Or a better question, when or why would it be worth it for them to do that? No one knows, huh? It's okay. I'm used to being lonely. I'll help you guys out here. So $500 a month times 12, $6,000. If they refinance, well, they can even refinance this in 7 months is really what I should be using, right? This person can purchase this house, refinance in 7 months, and not have to pay anywhere close to $13,000, right? So $500 a month times 7 is $3,500. They're gonna basically end up saving about $10,000 doing something like that, okay? But they have to be right out at month 7 for that to happen, okay? So it's assuming the person that just purchased a house still has a job, still has a good credit score, they can refinance out of the initial loan they got at 7.125%, drop their payment to below the 6.1 probably in this declining interest rate environment. 7 months from now, they might be looking at a better rate than what it is today, and be able to not have to have come in with that $13,000, okay? So we talk about other people's money and, kind of how people do this without spending money out of pocket. People are utilizing strategies like this to not have to come in with that money at closing. That keeps $13,000 in their bank account. That never had to be spent towards a transaction. When they go to refinance that house, that comes out of their equity, right? The equity was not money out of pocket. So they're still keeping that money in their bank account. And these are ways that people aren't spending money, but they are able to purchase assets and things like that, okay? So this is why lender credits come up. Marry to home, date the rate. Have you guys heard of this? Because you're going to be in the home, right? You're in a committed relationship. You're married to the house, but you're dating the rate, right? Because the rate could change. I wanted to point out to you guys, this is a snapshot from a subscription service I pay for called MBS Highway, okay, which is the mortgage-backed security highway. And they're pointing out over the past 2 years, the point in times when interest rates were the lowest, okay? So if you look at this diagram here, you'll see in 2023, we had low rates for a very short period of time. So keep in mind, when you look at this August to October, December, February, so when you look at these graphs, it's a month. It's about, actually, it's a 2-month, it's a 2-month time frame, okay? So rates didn't stay that low for long. You can see how low they're staying and for how long, and then how much time they spend going up, and then spend time coming down, and then how long it stays there. This has typically been a few days, okay? Interest rates stay low for a few days, and they go up and they go down. By the way, by the time you guys hear about it in the news, it's typically already changed directions, okay? So by the time you hear it, the news is typically about a week behind what your lender is seeing, okay? So by the time it says, oh, interest rates have hit, 5.5%, let's say that happened over here, which is about September of 2024, okay? It probably only stayed that way for 2 weeks, guys. Look at the lowest point. When you think about that, it's probably a few days. The rest of it, was probably over the course of 2 weeks, but it only goes down that low for a short period of time. Why am I bringing this up? Because when your buyer buys a house and they go to refinance, they have to be ready to take advantage of that low rate, okay? Because it's only going to be here for a short period of time. And this is kind of most recently when we get into September, which we just saw a rate decline in September, the lowest point that we've seen in a while, okay? Also, if you hear about mortgage rates going down, it is a bad strategy to wait to the day of the announcement from the Federal Reserve, okay? This particular graph, mortgage bonds improve until the last time the Fed lowered the rates was September 17th. This is basically interest rates improving. When you see green, that's good. When you see red, that's bad, okay? So interest rates were improving from the day they announced they were going to lower rates. Interest rates start to improve from the day that they project. When there's a strong projection that the Federal Reserve is going to lower interest rates, that's when you want to start paying attention. That's when you might want to start locking rates. The day of the lock, for the past 2 locks that we've seen, interest rates have gone up the day of the announcement that rates are going lower. So you got to be a little cognizant of that in today's day and age, because we're looking at probably 3 to 4 rate decreases over the next year. And every single time it's about to happen, your borrower or your buyer needs to be in a position to take advantage of that low rate, okay? So don't wait until the day they're going to announce it. Lock in days before, okay? That's just my advice to you. So questions for you. Since you're all so talkative, I'm messing around, okay? But I do want you guys to talk to me. How soon can you refinance a home after purchase?
After 6 months. So you're saying 7 because we have to wait that extra, the month we skip.
Okay, cool. Good job. Good job. All right. What's better, a temporary buy down or permanent? What do you guys think? Keep in mind the cost of the permanent buy down. Remember we had a scenario, the permanent buy down was like $18,000.
And temporary might have some other benefits which may help you refi in the future.
Exactly.
Okay. So I think maybe temporary. I mean, you'd have to be really pressed to know that your permanence is going to be more than 7 or 8 years.
And that
It-
is exactly why this is a trick question. Because it depends on your client. But exactly what you just said, Kelly. Hey, you know, what is your client doing? They gonna keep the house for more than 7, 8 years? I've got a very unstable person trying to buy a house. And when I mean unstable, I don't mean mentally. I mean like job stability is unstable, right? I want to lock this guy in permanently for 30 years because, you know, he's not going to probably, he's going to, you know, unfortunately, so all of our buyers are different, right? I have another person, very financially savvy. They want to, you know, get the seller to pay for a lower monthly payment for as long as they can, and then turn back around with these rate decreases, use their credit, and get into a lower rate permanently during the temporary buy down period. So I've seen different people have different strategies. Okay. So the answer to this one is it depends on your buyer, right? And their situation, because they have to be completely aware of what they're getting themselves into. Should sellers offer to pay for a temporary buy down?
If
What do
it
you?
means, yeah, if it means the difference between selling and not selling.
Yeah, but that could be $23,000.
It all depends how
They get to
soon
write
that
it
seller
off.
wants to get that property off the market too,
Mhm.
as well. You know, if they're a motivated seller, they'll do what it takes to sell their property. And if that means they're gonna credit the buyer 23,000, then that's what they'll do.
Right. So, you know, it's funny, Kellyanne, because your answer was spot on, but I just wanted somebody else to weigh in. but the thing is just that if it makes a difference between selling and not selling, right? You're like, oh, I'm gonna lose 23,000, but if you don't sell, you gain zero, right? So you got to look at that zero as a bigger problem than losing 23. Now, everybody doesn't have to do this. If a desirable house, desirable neighborhood, no, they may not need to offer that. But if they are offering that, you could also make it contingent upon a certain price. Hey, I'll offer you a buy down if you offer at least this much, you know? So it's just a strategy, guys, to help these, if you're on the listing side, get the property off the market. And if you're even on the buyer side, to help your buyer get into a home. Let's keep it going. All right. Are home values likely to increase or decrease over the next 2 to 3 years?
Well, if we perceive that interest rates are going to be decreasing over the next few years, then we would say they perform inversely. So we would think that home values are likely to increase. But if there are other pressures like government shutdown, other layoffs, and things like that, maybe not. Maybe the demand won't be there. So that's
Right?
just me. I'm going on mute.
No, that's okay. Keep them coming. Anybody disagree with that? If home values are likely, or if, let me just ask the question again. Are home values likely to increase or decrease over the next 2 to 3 years? Any other opinions? It's a safe space.
Increase.
Increase out. Okay, cool.
Yeah.
I believe they're going to increase, guys. I think that
Okay.
the high price that you see today, or people are calling high, are going to go even higher over time. If they're in the house and it's at 800,000 and rates go from 6.5 to 5.5, that house is going to go from 800,000 to 850. You know, if it goes from 5.5 to 4.5, the house is going to continue to, I mean, you know, it's going to continue to go up. So they'll be beneficial if they own the house already to refinance down to the lower payment. And the thing that people don't ever think about, but we don't get back time, right? So when's the best time to start paying on a 30-year mortgage? As soon as possible, right? All right, so Should buyers wait until interest rates reduce to enter the market?
No.
Why not, Kellyanne? So you be lying, Kelly. You going on mute? No, I was kidding. Go ahead, Kelly. Go ahead. Why?
There's an opportunity cost. So you just talked about the fact that you believe that home values are going to increase. If you're playing the interest rate game, you're going to potentially miss an opportunity to get a home at current value or current pricing. So waiting, there's a cost to waiting, and it could mean higher prices versus, oh, I'm waiting for a lower interest rate. It may not pan out as you see fit. Only way to get in, only way to know is to get in now.
I've had a few scenarios of this, guys. Well, I've had to go both ways. Okay. Most recently, when the Federal Reserve announced it was lowering interest rates, I had 10 active escrows going at the same time. Okay. Because I had people lined up ready to refinance, and I had some people lined up ready to purchase. Right. So, my phone, I was, things have been crazy, and I'm just coming out of that. Right. But they waited to get the interest rates lower to refinance, and some people waited to kind of make the purchase happen. Okay, good for them. But when the purchase refinanced, the average person saved $300 a month, right? Because that's kind of my go-to number when you talk about how much should you, like when should you refinance? When you're saving about $300 per month, because that'll pretty much put you in a position where by the end of the year you've paid for the cost of the refinance. Most refinances cost about 2%. 1% of that too is reestablishing the borrower's escrow account. That's their taxes and their insurance. So it's really costing them about 1%, because that other 1%, if they're already with a bank, they're going to get that money back. So it's almost like a wash. So it's really costing about 1%. So for that reason, $300 a month in savings becomes the thing to do. What is the benefit of a temporary buy down? You guys have
Well,
to sell this to your buyers. So
you don't waste all of your money trying to get a permanent one. You still get the benefit of having a lower payment to start out, and you can refinance when the time is right, if that's the differentiator for you. Like, I love this house, but I would really love a lower rate. Well, let's try a temporary buy down. When, year two, maybe even year three, you can try to get into something else, but you haven't wasted your money trying to buy it down for the life of the loan.
yeah. All right. And who should you refer all your loans to moving forward?
Carlden.
I had to throw a little something in there. All right. So as we wrap up here, programs that we offer, we're not just doing any one type of loan. Okay, we really offer almost everything you can think of: FHA, VA, conventional bank statements, 1099 only, W-2 only, no income doc loans, DSCR loans, down payment assistance. We also, I can't think of what's not on here, but we're really doing it when it comes to loans, guys. We offer private money, hard money as well. We have lower interest rates than retail banks. I just opened and beat Bank of America on a deal. Yay. So meaning that my rates are lower than theirs. My only competition is really credit unions, and for like veterans, like that's the only people I'm having a hard time beating. Everybody else, direct lenders, your standard retail banks, your Chases, your Wells Fargos, we're smashing the competition. We can close your loan in 14 days. Typically, this is for somebody who's like a W-2 only loan, not using down payment assistance, of course. That loan could close in as quickly as 14 days. We have great customer service. 30% of our business is repeat clients. We're knowledgeable. I keep me and my team in training for different certifications or what have you. We speak directly to your listing agents, help you sell your loans. So those of you who are not utilizing your loan officers to help you get a client into their house, I've seen a great success rate being that guy that calls the listing agent and just talks to them about the client's loan. Typically, I would say about 80 to 90% of those offers are going into escrow. So make sure you're utilizing your loan officers, even if it's not me, but it should. We answer the phone after hours. Depends on how after we're talking though, okay? And so far, well, this is actually an old slide, but we had 100% pre-approved of the close rate in 2022. This is the same class, 2 different flyers on this slide. I am a moderator for this class, covering mortgage basics, going over what some of the income basics that people need to know. We're talking about Cal HAFA, we're talking about FHA 100, we're talking about the HOP down payment assistance program. We actually had Dreams for All recently make an announcement that Dreams for All is coming back. We'll be talking about that. The LA City down payment assistance. We have a 1% conventional loan as well. That's mainly good for out of state. Your Nevada, your Texas, your Florida, your Michigan. That 1% down product is phenomenal. Shoot, I even might use it. And then, we're just here at the general questions and answers. So if there's any other questions, feel free to let me know. I'm going to keep this up on the screen too, just as we go through this. But if any of you who don't have any questions, thank you for attending. I know there has not been too many classes being offered really by anybody. So I wanted to try to make sure that I offered something in 2025. And I get a lot of questions about, how do interest rates work? How do buydowns work? How much you have to pay for points? How much does it cost to lower the interest rate to blah, blah, blah? All of this stuff is really a question you have to talk to your loan officer about, but now you guys have a little bit more of an idea how it works. Any questions so far? Or comments? Myra, this is great. Thank you. Myra, you're welcome. This is recorded and our slides available. Douglas, it is being recorded. I believe the Inglewood board will be posting it on their site. And yes, I can send this over to the board so that way they can disseminate it amongst you guys as well. Actually, you know what? I forgot. We have your information, so we can send it to you. So not a problem. Cute dog, by the way, Douglas. And any other questions? No one ever goes into details. I love to retake this when available. Aw. Cool. You texting and driving, Douglas? You dangerous, man. All right, cool. Well, if that's it, if you guys have any people that need down payment assistance, great class coming up, Home for the Holidays. It's not just for the holidays, but we're hosting it during the holidays. And 2026 is almost here. If you guys aren't marketing yourselves, call me. If you guys need any help, I have a whole marketing team that helps me with this stuff. Throw your faces on flyers, help get your name out there. We can't do it all, but we can help get you started, okay? So once again, my name is Carlden Lainfiesta, the Mortgage Fiesta. Follow me on Instagram, Facebook, all that good stuff. I do put out mortgage-related content that you can share or steal and duplicate for yourself. And I'll see you guys at the next training, class, seminar, function. See you guys soon.